At Peters MacGregor, we currently hold a number of John Malone's Liberty cable companies and want to highlight Charter Communications and why we think it's a great company in a great industry with excellent oversight with John Malone as Chairman of Liberty Broadband. John Malone has a relatively low public profile despite compounding capital at 30% for 2.5 decades, more than twice the return of the S&P. Our fascination with Malone goes back to 2012 when we read the book The Outsiders, which profiled 8 unconventional CEOs that dramatically outperformed the S&P over multiple decades. The book received high praise from Warren Buffett and was even put on his recommended reading list. At TCI, Malone gained a reputation for being a highly driven, low-cost operator focusing on long-term after-tax cash flows instead of short-term accounting profits. Malone was able to transform TCI from a ragtag collection of cable markets into the largest cable system in the United States before stepping down in 1996 and selling to AT&T in 1999. Our investment in Charter Communications is through our ownership of Liberty Broadband, whose primary value is its 20% shareholding in Charter shares. We decided on owning Charter through Liberty Broadband because it better aligns our interests with John Malone and also offered a second layer of value as Liberty Broadband shares were trading at a discount. At the time of our purchase, Charter was the 5th largest cable company in the United States, but on the verge of a gigantic merger with Time Warner Cable and Bright House Networks. If this transaction was approved by regulators, it would quadruple Charter's footprint and allow for massive synergies. At the time of our investment, and even today, the most talked about risk with cable companies is cord cutting, which is when a household no longer subscribes to pay TV. Not only are new media such as Netflix, YouTube, and Snapchat taking more screen time away from younger millennial viewers, but content costs have continued to rise at 3 times the rate of inflation since 2010. In a 2013 interview with CNBC, Malone discussed the much-feared cord-cutting trend.
Coming over the top.
This is going to happen, John. I've been doing this long enough now that I even can have an opinion occasionally. I mean, this is going to happen.
Of course
it is happening.
Sure.
And it's going.
Sure? Why was John Malone so confident that cable would survive cord cutting? As the name Liberty Broadband suggests, we believe Malone's investment in Charter was more of a bet on the growth of internet demand rather than pay TV. The expected increase in internet demand is incredible. According to Cisco, internet traffic is projected to triple in just the next 5 years. Much of this growth is due to video and the increasing resolutions that our high-definition screens are able to handle. Streaming one HD television for just 45 minutes uses as much data as an entire household does today. There are also large avenues for growth such as virtual reality, which can increase data consumption up to 10 times that of a comparable one-camera video. Delivering internet data is an incredible business for cable operators, especially when compared to delivering pay TV. Remember the rising content costs that we discussed before? Well, there's no content cost with internet data. This means that a large number of pay TV dollars can be offset with a smaller amount of revenue from broadband internet due to substantially higher gross margins. When a consumer cuts the pay TV cord, rarely do they actually reduce the amount of content they watch per day. Instead, they just shift their viewing habits. Instead of watching Discovery Channel on pay TV, they may decide to binge watch Stranger Things on Netflix. After a consumer cuts the pay TV cord, on average they end up using 2 times more data due to increased online streaming. Again, this reduces the risk to the cable company as any cord cutter becomes extremely likely to increase the vastly more profitable broadband internet plan. Cable compares extremely well to its internet delivery alternatives. DSL is cheap to deploy but has speed limitations due to the narrow copper line. Fiber has incredible speeds but requires expensive new cables, and cellular connections are fast but capacity is extremely limited. So, if cable is such a wonderful business, why won't its valuable economic moat be competed away by new entrants? Due to high infrastructure costs, a cable system is a natural monopoly. To start a competing cable system, you need to dig up city streets, sidewalks, front yards, walls, and of course you also have to sign up tens of thousands of customers to even have a chance of making it financially viable. As difficult as this is, Google has actually tried this with its fiber project. But after 6 years and hundreds of millions of dollars in capital expenditures, they are estimated to have less than 500,000 internet customers, which is an extremely small size compared to Charter's 20 million. Furthermore, in August it was reported that Google may soon lay off half its fiber workforce and attempt to pivot the service in a new direction. We believe Google Fiber's aim is not to become a major player in telco, but rather to incentivize the incumbent operators to upgrade their internet offerings. And on this front, Google has already been very successful, with all telcos recently announcing better speeds. Since our initial investment, the merger with Time Warner and Bright House was completed, and consolidated financial results were just released in August. Thankfully, the investment thesis is playing out as we expected, with a strong 9% adjusted operating income growth, even with fewer pay TV subscribers. To summarize, we believe that the Liberty Cable companies operate in an attractive industry, have excellent management oversight, and are well positioned to benefit from increasing internet demand.